Hello and welcome to this new edition of On the Record with me, Shireen Bhan. KV Kamath has been at the head of several important, significant reforms as far as India's economy is concerned, from the banking landscape to now what is likely to happen on the infrastructure pipeline as well as the digital landscape. This is also a time when inflation continues to be front and center, with the Reserve Bank raising interest rates to the highest level in 4 years and policymakers continuing to flag caution over rising prices. The world is moving towards more tightening, but the question is that warranted for India? Joining me now to discuss a whole host of issues with respect to the state of the economy is KV Kamath, Chairperson of the National Bank for Financing Infrastructure and Development. Mr. Kamath, always a pleasure. Many thanks for joining us here on CNBC TV 18. Appreciate your time. Let me get started by talking to you about the state of the economy with regards to inflation and what you make of the commentary that's coming from the MPC, specifically the minutes of the MPC's meeting, which clearly tell you that there is a division even within the MPC on the road ahead. What do you make of that?
I am slowly coming around to the view that there's a disconnect external between global thought leaders and central bankers, thought leaders in the sense theoretical thought leaders, as to how to deal with inflation and interest rates. If you see what has happened in the West, it's a complete break from theory. And I think it is right time for us to also rethink whether we need to see whether and what is the connection between interest rate and inflation by breaking down the components of inflation and then seeing what medicine is required. This context, before I talk about the commentary, let me talk about how, for just a minute, how well the central bank and the government have managed these two over the last 2 years, 3 years, and provided enough liquidity along the way. And that's why I think we are where we are. We did not increase interest rates as one could have expected. A knee-jerk reaction, no, it was not done. Liquidity was not tightened, it was kept easy. And you have the results to see. Look at it today. I would think that the central bank continue to do what it had done. Watch carefully, and that's what it is doing, and not necessarily try to do what the West may or may not be doing to find our own solution. As far as we are concerned, I just want to make another point. I think I'm getting increasingly disturbed by the fact that we have probably no reliable data good to go on. This is the policymakers, the regulator, the monetary policy. And it's coming out now, particularly, let us say, in terms of CPI now. And I'm sure the same will be in terms of other indicators. Question that comes to my mind is, are we measuring right? And I think we now need to measure right, because we are no longer a small economy. And I'm looking at our country going from 3.5 trillion to 7 trillion. And this is something that we need to fix now in terms of measurement, so that policy then can work with numbers which they are comfortable with. I think this is the reason I would think we see some debate in the MPC.
So, important point, and I think this is a reiteration of what you've said previously as well. You believe that there is a disconnect, and that disconnect fundamentally in your assessment is on account of the fact that there is no reliable data, in your words, when we talk about inflation. But given where we find ourselves today and where that's led the MPC's deliberations, do you believe that we're likely to hit a pause, or given what at least the RBI members are saying, that we are perhaps likely to see further tightening?
I really don't want to make a call on it. I think that's something that the policymakers need to do. But I would think that one would need to look at CPI or other indicators a little more, with more focus, as it were, to understand whether this is something that we can take a decision on. Look at the system, as it were. There is a growth momentum. What is happening in that context? Take other, I would say, indicators that come our way in terms of dipsticks or any other measure that you could take to determine what is happening, and then take a decision. Because we do not want to end up in a situation where we raise interest rates and put an engine, the economic engine, which is now fine-tuned, put it out of gear. Getting it back in tune is going to take time.
Do you believe that we're at the risk of seeing that happen? You talked about the economy being a fine-tuned engine currently, but do you believe that further tightening could risk and destabilize the recovery that we have been in the midst of?
Let me say it very clearly that I have complete confidence in the steps taken by the central bank as the monetary policy authority and the central government. So I do not think that they will allow this machine to get out of tune. I said there is a risk of that if some people get on this path that interest rates increases. We need to go in sync with the West. That's all I'm saying. But I'm sure that the monetary policy authorities will do the right thing, and they've done it over 3 years. So I have absolutely total confidence in what they will do.
Let me ask you about an issue that, of course, we haven't really got an update on, and I would appreciate if you could share some light with us, Mr. Kamath, on where things currently stand as far as the NABFID is concerned and the infrastructure pipeline build-out. Could you give us an indication of how much progress has been made, where you feel confident of, and where you see challenges today?
Yeah, as far as NABFID is concerned, let me put it in context. We started with just my appointment a little over a year back. We have now a full leadership set in place. So it's not just the board and a few people. There's a management team in place for the last 3 or 4 months. And they are now in the process of actually starting the approvals for the first few loans. The pipeline to me is strong. The national investment pipeline is strong. The monetization pipeline is strong. I think they are working through this pipeline to look at what. My view is that whatever was the mind of the government in terms of what the institution could do, that institution will do, but over the next a few years. And that was the timeline that was thought of. But now, since there is an executive team in place, I think the executive team led by the managing director are the right people to talk about where the bank is. But moving on to the other part of the question that you said, infrastructure, I see no slowdown. In fact, I see a speeding up on 2 fronts. Again, sometimes there's a question that the private sector is not involved. That's not strictly right. The private sector is not involved in those areas where over the last 10 years, I think it was probably very clear that these areas have a significant implementation risk due to a variety of factors, which are outside, in a way, the control of the private sector. For example, issues relating to land rights, issues relating to mineral rights, spectrum, et al. I won't go into the whole thing, which then ended up in a project being stranded. So it is right that these are done by the government. I think that's a correct step that was taken to keep the momentum going and look at the progress. We have to laud the government on that progress. So that progress continues. The private sector, on the other hand, are in certain other areas where they have found that the playing field is easier to navigate. So, for example, I would think the headline story there is telecommunications. See the way that business has grown, and with the private sector companies coming in, you're probably one of the most robust systems anywhere in the world at the lowest cost. So I think the public and private sector will coexist, and I would think that the public sector projects that are coming up. And that's where the monetization process that has been set in motion comes in play. As these assets get going, you then get them off your book, as it were, and use that money to finance something else. And again, I would point out the progress of this in the road sector and what NHAI is doing, with the InvITs coming in almost every quarter or earlier, getting fully subscribed on day one, and that too with retail investment. So I think we are seeing new things happening, and I'm sure this is all to the good. The common goal is that we have to hit the 25-year Amrit Kaal goal that we have set, which I think is somewhere between $30 and $40 trillion.
Yes, that is the aspiration and that is the target. But, Mr. Kamath, you said that you believe that the private sector's involvement across the economy, especially in the infrastructure sector, etc., is not going to slow down. In fact, you believe that it is speeding up. In that context, let me ask you about what we are seeing play out at this point in time with one of India's largest groups, and that is the Adani Group. Of course, what is happening as far as the stock markets is concerned is a separate story. What is the other side of the story is the group's ability now to go out there and do the kind of capex that was expected of them. There has been a retracing, there has been a sort of scaling back, a scaling down, if you will, across group companies at this point in time. To start with, I want to understand from you, what does the current crisis with the Adani Group stocks and the Adani Group mean from an economic point of view?
Yeah, I think, firstly, I don't want to talk about any specific group, Shireen. The market is functioning, the banks are functioning. The rest of it is, I do not really want to comment on it. I will only say this in a larger context that, my 50 years plus of being in the banking business, 52 years to be precise, I don't think that any single group makes, or carves out the history of this nation. So I have, really speaking, no concern that overall India will continue on its path of progress at the pace we have outlined. That's all I want to say. And I don't see any loss of confidence in India consequent to these things, because I think the external world now recognizes that we have our own regulatory checks and balances, which will keep things in check. So beyond that, I don't want to speak on any particular group.
Let me talk to you also about what we are seeing as far as the digital landscape is concerned. And I know that this is a space that you've been actively looking at and very confident of its growth. Whether we talk about UPI transactions, so on and so forth, we've seen the steady up move. Today, of course, reports about Paytm being in talks with another conglomerate for a potential deal. We understand that those talks haven't moved any further beyond the preliminary discussions. But how do you see the landscape shaping up? Do you believe that we are likely to see significant consolidation in the fintech space?
Yeah, Shireen, something interesting is happening in the fintech space. In the sense, the 60, 70,000, maybe now 80,000 entrepreneurs that were set up. I've gotten to see a few of them primarily in the financial services sector, and it's an amazing story. The platform value that they've created and what the platform can do is unbelievable. The problem is that their investors are of the mind that all you need to look at is getting to be a unicorn and pile up losses in the interim, which I think is an inappropriate story, path, and that has led to this story that we are talking about. Is it stable? Will it lead to mergers, acquisitions, and all? So I think there's a disconnect between value creation in the platform and valuation expectations. I think this is what entrepreneurs would need to first address, and their investors will first need to address. Thereafter, progress will happen, because progress certainly will happen, and these people are contributing a significant part to that progress of our economy. Now, coming to again, what is happening at the deep end, as it were, of the technology platforms. What I've seen over the 5 years, in the last 5 months, is the cost of technology has dropped to an extent which is unbelievable. I'm a strong believer in Moore's Law, and that is how we did the rollout in my old bank, ICICI Bank, going back 25 years. But today's costs are just unbelievable. When I started taking a deep dive, as it were, I had expectations, let's say, technology costs would be X, but now I believe that technology costs really are not even 0.2X, maybe 0.1X, of what I had in mind just 5 or 6 months back. So with this sort of change in technology costs, this is going to do the same thing that low cost of data has done to the wider public. That is, the Digitex and new builds, as it were, the new companies, will be able to come into being at very low cost. And they could provide great service to the country. And there will indeed be some disruption as a process. So we will see some exciting things going on. And the good thing here is that we are at just the start of this curve. And the whole digital process and the impact of digitalization in India and its impact on the GDP will be probably the next exercise that economists should really work on. I was just looking at numbers from China the other day. From 5 years back, almost nothing. Today, last year when I saw it, it was contribution to GDP was 35%. This year, the number is 40%. So my belief is that 5 years from now, if you look at India, how much incremental contribution will be there from digital economy is going to be, to me, a very exciting number. And that number, I would think, will not be less than 20%. I think it's in the 20-25% of the economy. So we are all undercounting our growth. So we have our growth as put out now, but nobody has a fix on what will Digital India contribute. It's going to be a significant part, not only in terms of growth, but also in terms of employment generation. We don't have a fix on the employment generation that's happening. Now, we might need to really recategorize the workers because, for example, if you look at the delivery system that's happening, going from e-commerce, we call them gig workers. I think we should not call them gig workers. We should title them properly. We should make sure they're under a structure which is properly implemented. And why should we keep, and we should bring them to the center of what I call the organized labor market. I do not know where exactly they're falling today. We should bring them to the center of the organized labor market so that we also have a proper idea of what really is employment and what is unemployment. So I think there are exciting things we could do. But bottom line, Digital India will contribute a significant part to our growth going forward.
So let me just try and get you to labor on that point a little bit more specifically, sir, in the context of Jio Financial Services. You do believe that this is an exciting time as far as the Digital India story is concerned, but specifically for the Jio Financial Services aspiration, what next and what can we expect?
Again, at this stage, we are working out the whole rolling out in a way the plan, not yet into execution mode. So all I can say is whatever was said in the demerger document stays. We are working on that to get the demerger out. And it would be premature for me to say it till the plan is approved and we roll out. But the background that I indicated to you, the cost disruption that I indicated to you, the leanness which we can build, I think all going to segue into any company's build out into including Jio Financial Services. So we are looking at a very exciting time of entry, where I believe there's another disruption that's happening in the technology context, the disruption happening in the aspirations of our people, and the growth momentum. So all should bode well for Jio or any new aspirant who's coming in at this point of time with virtually a clean slate.
Mr. Kamath, I want to go back now to the real infrastructure story. We just talked about digital infrastructure and the digital play, but let's go back to the infrastructure story in the context of NABFID. The MD of IIFCL, while speaking to us here on CNBC TV 18, said he believes that India requires a specific law for infrastructure. Now, A, do you believe that that is necessary? B, how is NABFID's role going to be different, for instance, from IIFCL's?
I cannot comment on what he will say because I do not know the context in which he said it, and I have not looked at it. I think NABFID's role is very clear in its charter, and I think it's a very, very expansive role. And its role is, I would think not only just a DFI, but also a catalyst. It could catalyze other institutions and so on. So I think the role, there are, I think, points where the roles would overlap in a way, and that's good because we need more long-term players. But the charter, to me, appears to be much wider than what is there in any other institution, and that's the reason why this institution was created. So, and I believe it is needed. I believe it is needed, given our earlier discussion in terms of what we see as the growth momentum over the next 25 years, the role of infrastructure, and the role of government in that infrastructure. So all these require institutions with long-term capability. Shirin, in this context, what I want to basically touch on is, we have had banks doing the role of a true infrastructure debt provider as an interim measure. After 2000 or 1995, 96, when the existing DFIs in a way did not have access to funds and went out of that role. Today, we have a situation where those funds are available. Those funds are available in the system through the insurance setup, through the pension setup, And even through the mutual fund setup, where savers are going in for various instruments and so on, and directly from the capital market. So there are multiple sources available today, and funding is getting done through a variety of means, as you see, long-term funding. So honestly speaking, the banks can do long-term lending only for a short time, not as a consistent, strategy going forward, because increasingly their funding is a shorter and shorter term. And again, as more technology comes into the marketplace, as it were, long-term instruments can be made to look like almost monthly servicing instruments. I just heard that NHAI has in mind to issue monthly interest to its bondholders. Can you imagine the change it will make? Here's a government institution, AAA, which the public looks at as government, offering you monthly interest rates which are significantly higher than either any rate that a bank can offer. So I think there's going to be a whole lot of disruption in terms of the way banks will need to handle their own growth and their deployment of assets. And if you have on an average 1 year money or less in terms of tenor, lending it out longer is you're putting your neck on a line with you do not know the consequences. So I think bankers will be more cautious in lending long out. And that is why I think the government's move in setting up NABFID is very timely. And we need to create an ecosystem to finance infrastructure. And I think that's going to happen. We will see it in the next 2 years.
Well, that certainly is the hope. Mr. Kamath, let me end by asking you, you talked about the growth momentum. So at this point in time, your take on where things currently stand, how confident do you feel about us being able to hold the kind of momentum we are seeing? And if I were to ask you about the single biggest risk that we face today from an economic point of view, what would that be?
Yeah, the single biggest risk I'll address first simply, and all along has been the unpredictable oil price. But I think we now have an indication what is happening to oil price for a very simple reason. We are not seeing the world, grow at a pace that they expect. It is very clear. And I've been tracking numbers from China, where the growth numbers look really, really, really low. From what feedback I have, which I continue to have in terms of what's happening there. Europe, we all know what is happening, and the US, I think, is just treading water, as it were. So given that the demand for oil, demand for various products is going to be low in the outside world. So we are lucky. So the oil price should then be stable, and we have our own market to cater to, which is growing well. So yes, it may be a bit of an insulated story, but I think we will weather this well. In the meantime, we drive our own strength through not only the digital movement, but through exports of what I call knowledge services, which is not going to slow down, because the world will need that. So we are in a sweet spot. See, growth stalls. When does growth stall? Growth stalls when there is no demand for what has to be produced. And in India's case, the headline, what has to be produced is put that infrastructure in place, whether it is roads, ports, airports, rail systems, whatever, airlines, whatever. That needs to go in. And, to look at where we are and where we have to go, get a long, long runway. So I don't see demand as a customer. So if you have a domestic demand, that creates employment, that creates aspirations. I don't think our growth story is going to get derailed on that account. What we need to make sure is that we nurture it properly. And as we discussed in the earlier segment, the key part of nurturing is steady policy, incrementally better policy, which is being done, and interest rates which are stable. The disturbance could have been caused, the shock could have been caused by external oil and such factors, not by demand, because we are in a way insulated. So I think we are in a good place with digital providing as a nice wedge as we go along, and all of us need to encourage that growth.
Mr. Kamath, always a pleasure. Appreciate you joining us here on CNBC TV 18 on the record to take us through what you make of some of the important developments that have taken place and taking shape over the last few months, and more importantly, what the road ahead looks like. Appreciate your time, and thanks very much for joining us. That is KV Kamath, chairman of the NABFID, with his take on the state of the economy. We are going to take a break, but return with the market action. Don't go anywhere. We're back in a minute with more.